Welcome, everyone, to the Retirement Success in Maine podcast. My name is Ben Smith. Allow me to introduce my co host, the next home in Remax to my Caldwell banker,
All
Curtis
right.
Wister and Austin Miner. How you guys doing today?
Doing well, Ben.
Good.
Doing well.
Excellent. Well, speaking of real estate, that's something that's on the top of mind for a lot of people right now. I think going through the pandemic, and you had people relocate to different locales because of remote work. You had our clients; their values have gone up of their homes, right? And now they have more equity than they've ever had. So that's part of our
Right.
financial planning that we've been talking about. But also now we got high interest rates. So if we're buying and selling property, well, what does that mean? So there are lots of questions coming out from the folks that we work with on a daily basis. And that's something that we just kind of have been thinking, I think, as our team.
Yeah.
Geez, well, maybe we got to get a little bit more insight here for what's going on. So Austin, like, what are you kind of seeing from your side here on the real estate end?
Well, obviously, Maine's very diverse when it comes to real estate and just as a state in general. So we have, amazing forests, great small towns, oceanfront properties. And so that presents a lot of unique real estate situations, whether it's finding a rental home or you're looking for just buying land, maybe
Mhm.
interested in logging. There's a lot of things that are maybe unique when you're looking at Maine versus the national real estate situation.
Sure.
So we thought it might be helpful to kind of zoom in a little on Maine today, talk about what we're looking at as Mainers, and then seeing how those issues are reflected on a national scale and if kind of compare and contrast there.
Yeah, that's fantastic. And like we like to do on kind of all of our shows, hopefully our guests know this by now. We like to bring in experts, right? We're all good at kind of what we do, but I will put my hand up. I am not an expert in real estate.
Nope.
So on today's episode, we have a very special guest with us who brings a wealth of knowledge and expertise to the table. Our guest currently serves as the Chief Executive Officer and Chief Investment Officer at Union Square Capital Partners, which is a firm specializing in real estate fund management. So before working at USQ, he was head of manager research at Nationwide Investment Management Group. Our guest holds a bachelor's degree in business from the Pennsylvania State University and earned his doctorate from Drexel University's LeBeau School of Business. He is also holds the chief chartered financial analyst designation and a certificate in commercial real estate from NYU's Schack Institute of Real Estate. So with that, I think we've just laid out how certainly educated and how much of an expert he is. So please join me in welcoming Tom Miller to the Retirement Success in Maine podcast. Tom, thank you so much for coming on our show today.
Yeah, thanks for having me.
Well, Tom, we kind of are setting up our show here, and we have lots of questions we want to ask you and kind of what's happening. But from our audience perspective, we always want to just get to know you a little bit and kind of what's shaped your worldview. So, love to hear a little bit about your career history and how long you've been in real estate investing.
Sure. So I've loved real estate for the last 25 years. I put myself through college working for a title insurance company, so closing loans back in the late 90s and early 2000s, and then got into investment management in 2006. And then you went through my bio there a little bit, just kind of worked my way through and have been investing in real estate now at Union Square for the last 7 years.
Awesome. So obviously, kind of title insurance, kind of that first piece, kind of landing into it was that something where you're like, hey, getting into college and it's like real estate was something you're just interested in, or look for jobs, kind of found like here's one and needed some income?
A little bit of both, but
Yeah.
have always loved real estate. And what I loved about that experience, I was actually able to, at the time, even being in college at the time, I was able to invest in a couple investment properties, and I still hold those today.
Nice.
So it's been, real estate has been central to everything I've done. Even as I got older and got married, and we bought our first home. We kept our first home, and we rent that out now as well. So we've just been able to build a nice real estate portfolio. And now I have the pleasure of investing, from an institutional basis in commercial real estate as well. So again, just center to everything in my life is real estate. So I love talking about it and happy to provide whatever insight I can here.
Love that.
It's awesome. Well, you're definitely the right person for the podcast today. So that's good to hear. So tell us a little bit about Union Square. What does the company do? What differentiates you from other competitors in the field?
Sure. So we run 2 closed-end interval funds. And what that means is we look and feel a lot like a mutual fund, but we redeem quarterly. So a little bit more limited liquidity. But what that does is it allows us to invest in private real estate. And so very different than publicly traded REITs, less volatility. And what it does is it gives us access to some of the best real estate in the country. And so we invest not exclusively in one of our strategies exclusively, but in the other strategy, about 50% in what they call the NFI Odyssey Index. And what that is it's an index that's comprised of 25 private funds. That's the highest quality commercial real estate in the country. And so I just want to make sure that everybody understands what I mean when I say commercial real estate. Yeah. Contrary to what the Wall Street Journal will tell you, that's so much more than just office, right? Mm-hmm. Commercial real estate includes retail, industrial, multifamily, and office. And as a matter of fact, in today's environment, in the United States, office makes up just shy of 20% of the overall commercial real estate market.
Mm. That's great. And thank you for that insight there. I want to rewind a touch, Tom, and talking about Union Square Capital Partners. What's kind of the history and really why was the company initially founded?
Sure. So we're a wholly owned subsidiary of a firm called Chatham Financial. Okay. And Chatham's been in real estate since 1991. And really, Chatham came into existence to bring trust and transparency to the derivatives markets. And what many people don't realize is many real estate owners and operators use derivatives to hedge interest rate risk. And so Chatham was founded in 91 to bring trust and transparency to derivatives markets. And then in 2017, they launched us because they felt there was no good way at a very reasonable cost to get into private real estate. And so here we sit today, 2 closed-end interval funds, 2 of the lowest cost closed-end interval funds on the market, and really kind of down the middle in what we do. We're trying to just make what was historically inaccessible more accessible to a broader base of investors, generally speaking, through registered investment advisors like yourselves.
Mm-hmm. Awesome. Well, Tom, I know that, so it's really awesome from a background perspective. And I know we want to get to the big premise of today's show is really what's the future of real estate, locally, but also nationally for us. So love to start with some basics. So in terms of like from a trend perspective, what are you seeing for trends that are happening right now nationally in real estate this year?
Sure. So a big push, industrial real estate. So think Amazon and logistics buildings. Everybody still loves logistics real estate right now. So industrial. Multifamily has really been a good spot for the last 5 to 7 years as well, and looks like it will be in the future as well, and as well as single family residential. The headwinds that we're all reading about really are around office and downtown urban areas, and will workers return to the office? I think that's still a little bit unknown. We're only back to about 50% occupancy within office. So that's the challenging part. And I think that's really the national picture. So office, there's question marks around office, but multifamily and industrial, really strong operating fundamentals. And then within retail, retail for the last decade, we've been saying, there's going to be problems in retail, malls are dead. And that's really not the case. What happened with retail is Class A retail, experience-based retail is actually coming back very strong right now. And so, I think that's going to be the same thing that happens in office as well. Not all office will survive, but good, highly amenitized Class A office will be just fine. And we're actually seeing tenants flock to those types of buildings.
Okay, no, that's interesting. So yeah, my next question is actually around the effects of sort of 2020 and people that started working remotely and then they were able to move away from where their offices were located. So as Maine is a more remote state, we saw a huge influx of people during that time. So you said obviously people are kind of moving back into the offices more now, but what does that look like as far as the residual effect on where they've bought their new homes maybe? So if I've lived in Massachusetts, worked in Boston, and then moved to Maine, am I now having to move back, or are we seeing any changes there?
Maine's so beautiful, nobody wants to move back. So
Right. That's exactly right.
That's the problem. It truly is the problem. But I think I don't think so. I think the fact of the matter remains, and this is in Maine and nationally, we're undersupplied in homes, right? So I don't think, even as workers do have to get back to the urban areas, having a second home or keeping their real estate is still highly valued. So I don't think you're going to see a big decrease in home prices. It's a supply and demand function. It's kind of going back to Econ 101, right?
Sure.
We have too much demand for housing and too little supply. And so because you have that, even in the environment of higher interest rates right now, those dynamics, those supply and demand fundamentals will win the day. And so we're seeing that right now.
Tom, can I ask, like, this is maybe just a little bit of a rabbit hole, but I think there might be a clarification that would be helpful. Is, so when you say there's limited supply of homes, well, I think what could be kind of challenging to think through is, like, well, how is there limited supply of home? It's not like you have all these people homeless out here that don't have a home, right? So
Right.
they're living somewhere currently to get into a home. So can you just explain that dynamic when you say there's a undersupply of homes available for people?
Sure. Household formation has outpaced new homes. So in effect, people are growing up, getting married, having kids, and they would want to buy a home, but they can't right now because there's no supply. And now with interest rates going up, it's much harder to afford. So where are those people living? They're generally living in multifamily, or they're renting a single family home. So when I talk about undersupply, I mean undersupply of single family homes available for purchase, for the typical starter family. And so multifamily has filled that void, and we think multifamily will continue to fill that void for the foreseeable future. So think in the next 5 to 7 years, multifamily is going to play a big role in this country. And even if the home builders wanted to build new homes today, you don't have the labor force to do it. So even if they went full force today, you still have years of building ahead of you before you bring that back into equilibrium. So before supply and demand meet each other.
This is just a kind of a question. I didn't know if there's a data point out there in there, but is there, just based on construction rates and is there kind of this projection that the real estate industry has out there about when that undersupply gets corrected? Because obviously there's a market opportunity, right? As if you are,
sure.
if prices are going up or there's demand for it, and how do you know when you think that might ease, I guess, is the question.
Yeah, it's an interesting question, and the question really comes down to how undersupplied are we, and that number is really hard to pin down. Some would say 6 million, some would say up to 12 million. So there's definitely limited supply. In terms of time frame to correct that, it depends. I mean, and the home builders today are building, but they're building on a limited basis, and they're building, and what they're doing in the face of higher interest rates, they're adding on, and they're buying down the rates for people to get into those homes. That's not really an environment where they want to build an extra 100 or 150 homes on a site, right? They're going to build what they know they can sell, and that's all they're filling right now. They're not. It's not like pre-2008 when home builders were turning everything on and everything was booming. It's much more calculated in this environment. And anecdotes, general rule of thumb, when the 30-year fixed rate mortgage is above 6%, that's when home builders start to get weary of putting a ton of new supply out there because foot traffic goes down. And so now that you have a 30-year fixed rate mortgage, it touched 8% 2 weeks ago. It's since come back down to 7.5, 7.30, but still that's pretty high relative to where things have been historically over the last, call it 10 to 15 years.
Yeah, absolutely. And I'm going to rewind us a minute because you said something a couple questions ago that I really want to dive into. So I am going to rotate us out of the home conversation for just a second. And I want to get back talking about office buildings, right? couple minutes ago, we were talking, Austin kind of teed that up. You made a statement that, long term, you don't think they're really going any right. Again, maybe not all office survives, right? Can you just kind of elaborate on that, kind of your outlook for office buildings, and then kind of maybe if it's not being used for office buildings, like what are some of these other uses for this type of commercial real estate?
Yeah, it's going to be more mixed use moving forward. We've seen that trend happening prior to. So what does that look like? An office building is retail on the bottom couple floors, maybe some multifamily, and then office on top. And so that's going to happen. The problem is everybody says, and I think even the administration came out and said, hey, we have all of these office buildings out there. Why don't we just turn them into multifamily? Well, it doesn't exactly work like that. So the floor plates for commercial real estate or for office buildings, I should say, is very different than multifamily. And think about things, just simple things like bathrooms, right? And windows, some pretty basic needs that you need in a multifamily place. The office building doesn't really lend itself without quite a bit of construction and a lot of money to be put into that. So you're not going to be able to just convert all old office buildings into multifamily, but I think mixed use will win the day, and you're going to continue to see that. And again, highly amenitized Class A office is seeing leasing activity pick up basically throughout the country. There's a couple pockets, a couple cities that are still pretty slow to recover, but generally speaking, highly amenitized Class A office is doing okay.
Well, Tom, I know we're just trying to canvas a lot of the different types of real estate out there and kind of pieces of it. And it's something we have a lot of in Maine is trees, right? So timber is kind of a theme as well, right? In terms of real estate that people might not think about in terms of, hey, land and kind of use. And I know in our state, we just, having this kind of theme about owning forest land and just having either just maybe there's a use of harvesting that eventually where they go and there's an investment that they can make in terms of going and harvesting that property and using the timber replanted, or maybe they're just kind of thematically doing that over time, right? Here's the trees that are ready to be harvested, and there's a way to kind of get a level of income from the land, not just a buy and sell, right? So I know there's and Austin and I had a client meeting the other day, and the client was like, the goal I have, he's buying up all this timberland and property, and he's like, preservation's my thing, right? Is I want to preserve this. I don't want vehicles coming in and out of it. I want the rivers pristine, and I want the trees to be 200-year trees that keep going. So I guess the question is for that specific client where he's gobbling up all this land he wants to preserve, how does that kind of the value of these sorts of property and timber, how does that play into how you value property in terms of the landscape here is my question.
Sure. And that's hard because commercial real estate, when you think about it, it's really valued as net operating income, right? So everything's run off of a discounted cash flow statement, or what they call a cap rate, which is net operating income over purchase price. So what you're asking is, if you don't have income, how do you value it? And generally speaking, I would say the way you think about it is land is a real asset. And so as inflation goes up, the cost of land will go up as well. So land is just a great inflationary hedge. So just owning land for those reasons alone from an investment perspective is a great inflationary hedge. And then when you do start to, there is an index that does follow timber specifically. So I looked it up in preparation for this podcast. And when you start to get land that does yield income, generally speaking, it's annualized over the long term, about a 7 to 8% annualized return to own timber and to harvest it. So that's a good return when you think about it over all the economic cycles. And so I will never be negative on owning land. I think it's, real estate in general is always going to be a good investment over time. Now, if your time horizon is 1 year, it's probably not the investment for you unless you're going to try to flip something. But generally speaking, if you're a long-term investor, you really can't go bad with real estate. And that's just been, it's proven itself time and time again throughout history. And I love that, many people call real estate an alternative. but let's be clear, real estate ownership existed before stocks and before bonds as well. So it's an alternative to stocks and bonds in one capacity, but it's been the single biggest wealth creator in history. Owning real estate has been the single, not the only way, but one of the only ways, or has generated more millionaires than any other investment scheme out there. So real estate, I'm definitely long on real estate and definitely long on acquiring land. If that's, if that's something that your clients can do.
Sure. Interesting. No, that makes a lot of sense. I wanted to get back to some rental real estate questions. So you had mentioned earlier that you see multifamily rentals having a strong demand for the next, say, 5 to 10 years, somewhere in that window. How does that translate to like vacation rental properties, things like Airbnbs? Because Maine's a very heavy seasonal tourism state. So that's something that a lot of people are kind of questioning. Should I buy a house to invest in and then I stay there sometimes too? What does that demand look like in the future?
It's still very strong. I think it got a little bit ahead of itself. Everybody wanted an Airbnb, so they were buying them all over the country.
Yeah.
And that's since weakened a bit. But over the long term, again, I think if you have realistic expectations, you're exactly right. A place like Maine should always have demand for people to come and Airbnb. Now, are you going to be able to rent it for $5,000 a week? If that's yet to be seen. But I think as demand will ebb and flow. But generally speaking, you're always going to be able to rent, really well-maintained properties in areas that are attractive. And so I still think that's a good, a good investment, again, as part of an investor's overall portfolio. They shouldn't sell everything else and just go, hey, I'm going to go an Airbnb strategy. But as an overall well-diversified portfolio, I think it's still a good investment.
So Tom, I want to kind of maybe ask another question here, because you're talking about Airbnbs, and I know one thing that we're just seeing locally, and we've had kind of conversations actually with one of our former teammates, Abby. She's bought kind of this thing, like she bought a multifamily on her own, and then they turned that into, here's like a office building she's looking to buy, and so she's kind of created this using equity of one to buy the next, and you see that theme happening even more right now because there's a lot of success that's been built over the last few years, right?
Yep.
And we kind of laugh a little bit because the real estate agents, they got their TikToks, and they got here's a minute of, you just take your equity and you just flip that into the next thing, and then that creates all the income, and it's just easy, and it's just and it's all good debt, right?
What could go wrong with that?
What could go wrong?
Exactly.
So I guess what I love from your side, because I know, as you said, you kind of have done this personally, where you've owned some of your own properties. And then professionally here, you said, hey, I can apply my talents and my knowledge of real estate to create more diversification, create a fund for investors. I would just love to hear a little bit about compare and contrast here from this personal investing. People want to own it and touch it and feel it and see it, and be able to kind of use their hands and their talents to get that ROI, versus the invisibility, I think, of here's a paper investment that goes up or down that they don't really see the improvements on. So can you just talk about, kind of compare and contrast, maybe risk return profiles of those two things? Because I think right now I think locally, we just see there's just a trend towards just buy up everything locally, and we're going to be
see what happens.
Millionaires. Yeah.
Yeah. No, it's different. I think the way to evaluate real estate, we talked a little bit about it. Cap rates are what everybody, and I don't love talking about cap rates because they're misunderstood and oftentimes misquoted in the media. But cap rate in its simplest form is NOI over purchase price. And so on an institutional cap rate today, when you think about it, what should a commercial property yield? Well, because office has more risk, the cap rate should be a little bit higher. So think 7 to 8%. So 7% to 8% income off of the purchase of that property. Whereas, multifamily and industrial, less risk right now. So those cap rates are going to be lower. So when you evaluate real estate across the board, you can still apply that same technique over to buying your own rental property and say, okay, I'm going to spend X dollars. So let's just use simple math. I'm going to spend $100,000. I'm going to buy a property. And I know that's very low, but just use it for simple math. Follow me here. And I'm going to make $8,000 a year in income. That's what we would say is an 8 cap, right? So 8% cap rate. And so you have to evaluate that and say, okay, well, with an 8 cap, if I could take that same money and invest it somewhere else, would I make more than 8%? And that's the question that you would have as you're going into the investment. But I would say leverage and debt used appropriately and prudently is a very, very powerful tool. And so with what we do, the funds we invest in keep leverage 35% or lower. And in today's environment, they're only levered at about 25%. But on the residential side, if you can lever and take that money and apply it to another home, again, used prudently, that will really magnify returns. What you don't want to do is go buy an investment property and then lever it all the way up to a loan to value ratio is nothing more than the amount of the loan relative to the value of the property. So when you think about when you buy your first home, generally speaking, you need 20% down, right? So that would be an 80% LTV. So as long as you keep that leverage profile down, so in investment properties, when you're borrowing, most lenders want to see 25% down. So if you can meet that hurdle, put 25% down, rent it out, and make sure that your income is exceeding the cost of that leverage and the cost of the maintenance of that property, then yes, that's a good investment. And over time, that will certainly yield benefits. And I'm a big proponent of using debt prudently. What I'm not a big proponent of is using debt irresponsibly and then going up to that 100% LTV and then just saying like, this can never go wrong. That's where things exactly go wrong. So if in your mind you're saying this is a great investment, this could never go bad, you should probably stop. So that's kind of the same techniques across both. And I know that was a long-winded answer, and I apologize.
No, but I think that's perfect, Tom, because I think so. And just to kind of the ROI is right. That's a net ROI, right? Because if I have as you said, like interest rates are now approaching, say 8.5 or whatever, right? Is like I need to have that level of income after those costs, those maintenance costs and the debt and the interest payments and all of that, right? This has got to be my net payment to basically pay for the level of risk that I'm getting out of this, right? I think that's a key part. But two is I want to ask so people are good about the building, right? So they're all excited about the building, and I turn one property into two, and I turn two to three. Well, I think one thing that just we see as we're talking to folks that have this is they have not thought about how do they unwind that chain. Right. So they build up to, I'm going to get 20 properties and then I'm going to get all this income out of it. And I can sit at home and I can just cash checks. I'm just doing the Uncle Scrooge thing of just checks coming in the mail. I just cash it and there it's all good. Where I think at some point where, hey, I'm going to be 60, 65, 70, 75. I'm not able to manage this, or I might have a property management. I'm not able to maybe get the value. I don't want to give it to my kid that maybe doesn't know real estate the way I do, or these properties specifically. How do I unwind it to get liquidity? So I want to ask the question of the difficulty of unwinding that empire that you build versus, again, the work you do through your fund, and hey, here's how I can try to achieve a different return risk profile, but also the unwinding moment of that too.
Right. And so our product does not allow for this. Mutual funds don't allow for this, but there are other real estate firms that offer what they call 1031 exchange programs. So where you can sell real estate, and as long as you roll it into a comparable property, you don't have the capital gain tax implications for that. Take that a step further. There are companies that will help you effectively manage your tax liability by transferring your property into a real estate investment trust and then taking shares of that. But generally speaking, you really have to be careful on that because there's a lot of fees and a lot of people in the way of that return, if you will. So you don't want to build up this great empire and then have it eroded by everybody else taking a cut of that as you unwind it. So you have to be careful. It's something to pay attention to. Generally speaking, my thought is think about real estate as a long-term investment. and hopefully you are going to leave it to your heirs, right? You should think about it as a generational investment, stepped up basis, tax basis when you do roll it. And so that's kind of the way to think about it. That said, if you do want to unwind it, I think just like anything else, talk with your advisor, talk with the local real estate agents about when the appropriate time to sell is, and what are you going to do with that liquidity. So it's part of the overall financial plan. And again, capital gains, nobody loves to pay taxes, but at the end of the day, it's kind of a necessary evil of investing as well. So sure. I would caution, as people unwind their real estate, it's okay to pay a little bit of tax, right? By the time you're trying to do the tax avoidance strategies, oftentimes you're eroding the returns away anyway of just paying the tax. So you really have to think that through. And so it's something that, we look at these products all the time and we see layers and layers of fees, and we say, well, in some cases, the investors would be better off just paying the cap gains tax and moving forward.
Yeah.
And so,
So Tom, I want to kind of take that just one step further, because I think to one point it's like, well, I'm going to retire and I want cash out of it eventually. We've actually had a client experience where they've been pretty successful with commercial real estate. They've done really, really well, so much so that the value of that commercial real estate is going to create a sizable estate tax, right? Mm-hmm. So it's like, here's a very large estate tax number that's going to come out of it. If they pass away today, it's going to be tens of millions of dollars that they're going to have to pay the IRS within 9 months after passing, right? So, okay, so that creates another challenge where it's like, I die with this portfolio,
right?
And say, as you said, it's a long-term investment in, I'm just, you kind of go to the worst case scenario. It's the financial crisis. And now you got to liquidate all this property at the wrong time to create enough cash and liquidity to pay the IRS tax bill on your estate tax. So I guess how have you kind of seen folks kind of think about that as well to make sure that, hey, I got liquidity that pays it, or I'm not fire sailing stuff at the wrong moment.
Yeah, so in a portfolio, I wish we could all be that lucky, Ben. To have
yes,
that
I know. I want that problem.
Yeah, I certainly want that problem as well. But I think what you're talking about there is a very, very unique, less than, I don't even know, 0.1% of people are going to have that problem. In that case, I would suggest, especially in the commercial real estate space, that's where you can get a little bit more crafty in terms of transferring that property, taking shares of what they call an UPREIT transaction. And so you can definitely think that through ahead of time, which solves some of the problems that you're talking about. So you get liquidity, you don't have to sell all of that and recognize all that taxable gain, but it gives you flexibility from an estate planning perspective as well. And so that's again, not the proud for the masses. So my earlier comments, my earlier comments there were much more about, you don't have a huge portfolio. You have maybe a couple $1 million worth of real estate, and that's kind of the way you do that. But as you start to get tens of millions of dollars, that's a little bit different, and those strategies will be much more beneficial for you as you get into those tax deferral strategies, if you will.
Got it.
No, I appreciate that. I want to rotate to something that we think is pretty specific to us here in the state of Maine. So obviously Ben, Austin, and I all are currently sitting in the state of Maine. Maine has a lot of smaller, close-knit communities, naturally being as rural as we are. Sometimes these communities can be a bit skeptical of and I'm going to put in quotes here, the out-of-staters or the out-of-towners or the out-of-state money, whatever you want to call it. So I want to ask you, Tom, kind of what does your kind of boots on the ground process look like when you're trying to evaluate investment opportunities in these types of locations?
Yeah, so we invest in funds, remember, that have teams and teams of people that are certainly local and talking to the local brokers. And so very, very thorough investment process. And what I would say there is oftentimes, generally speaking, for commercial real estate, you're staying in your major metros. So a lot of what we do is in your major metropolitan areas. But in your case, I totally understand. And it's interesting if you look at some of the out of towner cities, right? So this pandemic, a lot of people moved into places like Boise, Idaho, and you've seen an exodus come back out. Perhaps that's culture. Perhaps that's they have to go back to the office. That I'm not sure of, but I do think, look, that at the end of the day, having more interest in the real estate that you all own or in your communities is a good thing. So out of towners coming in, having more demand for that real estate is only going to be net beneficial over time. And I know nobody likes the out of staters to move in and all of that, but generally speaking, I view it in much more of a silver lining perspective and say that's actually a very good thing, because that means that the area that you own in is in high demand, and that is going to push values up. So I would say that that's definitely a different way to think about it. I know not everybody listening to this podcast would agree, but I would say try to see the silver lining in some of that.
Yeah.
Awesome. Well, Tom, I know one theme, because you've talked about this a little bit already, is shopping malls, the retail side, right? Is that's been an area that, the internetification, if that's a word, of retail, right? Where we're all pushed to go, click on an Amazon link, and 3 to 5 business days or next day or same day you get that package. So why do I have to go to the store and make it a big thing? So shopping malls have long been a decline. This is not a 2023-24 theme. This is well there. But I think what's interesting, we read right now, like Carl Icahn, right, is he's making these big bets. Shopping malls are going away. They're going to go all bankrupt, and he's going to make and this was his biggest bet, and he doubled down on it. And kind of maybe not so fast, my friend, is what Lee Corso would say, right? Is that something where, totally, that's not totally going away? So a question to you is, obviously he viewed it that way, and he viewed it was going to go completely under. What trends are you seeing with real estate inventory with current malls or closing malls? What do you see?
Yeah, so Class A malls, experience-based. So think high-end retail, good locations, farm-to-table restaurants. That retail is doing just fine. So Class A malls, and if you look at the publicly traded REIT space, Simon Property Group is one of the biggest mall owners in the country. Their properties are doing just fine. And if you read their earnings reports, they'll tell you occupancy in many of their locations is 90-95%, which is very strong. And so I would say not all retail is dead. Class A, experience-based retail is going to do fine. Class B and Class C is a little bit interesting. And I can tell you just anecdotally and what we've seen, that does lend itself to other areas and other industries moving in. And so one local mall here in the Philadelphia area, it's what we would call a Class B, maybe even Class C mall. The entire bottom floor has been turned into medical office and imaging, right? So MRI imaging, where you need a lot of space. You need very, a good air conditioning or HVAC unit to keep the equipment cool. And then, so the hospitals don't have to keep all of the imaging equipment there. It's in the bottom floor. People go there for their outpatient services. That's been a tremendous tailwind for some of these larger spaces that you need to rent. So things like that. The one thing that I would remind people, a lot of the trends in real estate take a long time to develop, and real estate owners don't just sit there and say, well, we had a mall, it's not good anymore, we're just gonna, go by the wayside. It is what it is. That just doesn't happen, right? They're gonna find ways to reinvent that space, and so that's just one example. So medical office in the lower floor of the mall, multifamily in some capacity. Some of the malls have been removed, and highest and best use of that land will ultimately things will be redeveloped there. And so I think what's super interesting about the pandemic, we were all locked in our homes, right? And it certainly put fuel on the fire for Amazon and home delivery of all goods. And that's certainly helping and a tailwind for industrial properties. But what the pandemic also taught us was you can't lock us in our homes, right? So you want to get out there, you want to spend money.
Sure.
For goodness sake, right now, you have a Fed trying to slow the consumer down. And what are we saying? Nope, we still want to go out and spend more money. So when you think about it, as long as it's experience-based and people are going to something that they want to go to, whether it be open air or the nice restaurant or whatever they want to go experience, that type of retail is going to do just fine. I think we've proven that there's a balance. So over the last decade, as we've read, all brick and mortar is going to go away. That's just simply not the case.
Yeah.
Oh, thank you. That makes a lot of sense. And actually, so kind of going along with the trend of experience-based, Maine, like we talked about with my question about vacation rentals and things like that, it's very scenic, whether you like lakes or mountains or oceans. So residents of Maine, but then also people in other states look at Maine as a place for maybe a second home or a vacation home. And I live in Kennebunk, so by the coast there's a lot of really huge luxury properties. What has the market been like for like second homes or luxury properties? And does that kind of move in tandem with normal residential real estate, or is that its own thing?
It's really its own thing. And what's again interesting about that is, generally speaking, when interest rates have gone up in the past, that's kind of hit the higher end of the market. People said, all right, let's take a pause. So usually your higher end gets hit first because there's plenty of demand that still will outshine there in the call it the lower range, the middle income range. We haven't seen that in this downturn, if you will. You have so many cash buyers out there right now. The economy is flush with cash, and so it really, second homes are still going strong. High-end luxury homes are still going strong. You're starting to see that wane a little bit, not so much in the second home market, but in the luxury primary residence market, that demand is starting to wane a little bit right now. But generally speaking, because you have so much cash in the economy, those second homes and those luxury homes are still holding up. You know, that's not to say that will continue, but to date, they've held up pretty well.
So, Tom, you kind of raised a point there that I think is a good question there, because you kind of saying that, hey, when interest rates go up, and obviously that can hurt maybe some of the higher end of the market, right? Is all of a sudden that, because obviously interest payments on larger values can make it much more unaffordable, especially when it's a superfluous purchase, right? Is this like, I don't need it, but now I really can't afford it because of the high level of interest rates. So I want to ask maybe zoom out on the interest rate question here about just generally, because I could see where from a myth busting perspective, I could just throw out, geez, well, rule of thumb, interest rates are higher, bad time to be in real estate because you pay more interest. Can you talk about how you as a fund manager look at that of like, obviously interest rates are higher. Well, that does not mean that the whole asset class is now like not touchable and not investable and not a great place to be. So can you talk about that dynamic? Because I could see where that would be the thinking that would be out there.
Sure. So certainly within commercial real estate, that the equation is, remember I said NOI over purchase price. So if you're growing NOI, that's taking the cap rate up as well, right? And so that's what everybody always misses. They say, oh, higher interest rates. But in inflationary times, and generally throughout most years, you're going to see income growth within commercial real estate. And so multifamily rents are up, industrial rents are up, and they were record setting in the last couple of years. Now things are certainly moderating and coming back down to normal levels. But within a commercial real estate space, that's the piece you have to understand. Higher interest rates don't necessarily mean doom and gloom. Yeah. In this environment, what I would say about interest rates, and the consumer did it as well, and most commercial real estate operators did it as well. They locked in longer dated debt at low interest rates.
Yeah.
And quite candidly, it's why the Fed's interest rate hiking cycle hasn't worked. It's because most people, I mean, if I talk to 10 of your clients, 9 of them have probably locked in fixed rate mortgages at 3% or below.
Absolutely.
Right.
Yep.
And so why would you sell? So there's you have a supply problem that's helping the supply problem. And you've lost a lot of buyers coming into the space as well, because the interest rates are higher. So you don't want to refinance. You don't want to go buy a new home yourself and lock in at 7%. Which is a bit of a psychological thing as well, right? Like even if your home appreciated in value by $300,000, you don't want to take that gain and go buy something else because you can't stomach having a 7% mortgage when you just had a 2.5% mortgage. So, a lot of interesting dynamics in this cycle. And so commercial real estate, basically every corporation that takes debt across the country, has locked in low fixed rate debt for the most part. Even think about some of your big conglomerate corporations, Coca-Cola, Pepsi, they all issue a lot of debt, right?
Sure.
But it's at low rates right now. What I think will be challenging moving forward. And so right now, everything's worked as it's supposed to. Income has grown. Interest rate payments have not really taken too much of it. There hasn't been too much of an issue in the markets. That said, as corporations have to refinance that debt, so that looks more like 2026, 2027. If that has to happen and these interest rates stay higher, then I think you're going to have a bigger problem. And that would hold in all real estate. That would hold in commercial real estate as well. But right now, I think it's been prudent management with leverage and locked in at low rates for the next few years. Things should be okay. Again, if the Fed continues to take rates higher, or if the long end of the curve, more importantly, the 10-year continues to go higher, you could see some problems. But that's not a commercial real estate problem. That's an economic problem across all industries.
But Tom, I guess want to make another point to that too, is obviously from a financing perspective, like just because, so obviously when rates go down, we refinance into lower rates, right? Right. We tip, obviously from the buyer perspective, where we go from one property to another, I'm talking residential, you might be newly financing into higher rates, but you always have the ability to refinance back down into lower rates. Just because you bought it, say an 8% mortgage, doesn't mean that you're locked in for 30 years at an 8% mortgage. Now, to what you just said is, if it just kept going up and up and up, well, yeah, you would be, but cyclically, there might be opportunities there over a 30-year time horizon, 20-year, whatever the mortgage rate is, to then refinance down, which I think some people forget, or that's why they get scared to enter into debt at a certain level too, right?
Certainly. And that's definitely on the residential side.
Yeah.
Commercial real estate lending works a little bit different. You can't just prepay on a commercial real estate loan in most cases. So a little bit different of a thought process on that side, but you're absolutely right. On the residential side, you do have to remember rates. I mean, even the Fed right now is saying, yeah, we're keeping rates here because they're restrictive. We may have to take them higher to be restrictive. Eventually, they won't need to be restrictive anymore, right? And hopefully it doesn't come with a deep recession, but rates should start to come back down. And at that point, you're right, you can refinance. But it's even though you've seen big gains in real estate, even though that point certainly exists, we haven't seen the movement that you've seen in past cycles. You just haven't seen people sell out of their homes and buy new homes. And I think it's just psychologically different this time in terms of, but if people believe that rates are going to stay at 7.5% or 8% for a 30-year fixed rate mortgage, maybe you start to see some of that pick up now, but yet to be determined.
That's great. No, I appreciate the insight there. And I know a couple times we took you a little bit into these rabbit holes, but I think it's really helpful. And so we've kind of reached the end here of our conversation. So I first want to say thank you again so much for coming on the show. The knowledge and expertise you provided was phenomenal. I do have one last question for you that I try to ask all of our guests. Sure. The name of our show, again, is Retirement Success in Maine. So I want to ask you, how are you going to find your personal retirement success, Tom?
Well, you gave me a softball on that one. Real estate, naturally, right?
There it is.
So,
there it is.
I kind of alluded to that in the beginning as well. Look, real estate is in my veins. I have rental properties myself. I now, like I said, have the benefit of investing more institutional capital. So I can't. There's no other asset class that has shown the consistency as commercial real estate. So if you go back to 1978 and you look, there's only been 3 drawdowns, and we're in one of them right now, right? Yeah. And so generally speaking, real estate's going to appreciate. So from my perspective, that's a key part to my retirement success. Obviously, I'm diversified. I do invest in equities and fixed income as well, but will certainly be key to my retirement.
I love that.
Tom, perfect answer. Thank you so much for coming on our show. I know we really appreciate all you provided here today, and looking forward to maybe at some point to hear a little update as well. So thanks so much.
You got it. And I'll be up in Maine soon because, I do love the state. I might have missed it now, Have the leaves all fallen at this point, or is it still the okay?
Yeah. It's kind of there, but that's okay. We'll have to schedule you when it's maybe a better season. So thanks so much. So I was pretty excited we were able to connect with Tom Miller today. I thought he was amazing. Again, Union Square Capital Partners there kind of has this not only just real estate, but also like a fund in terms of private real estate as well. It's its own thing. So able to kind of get into a lot of, I think, the opportunities and some of the risks that you see in different types of real estate, especially I think where it's just so hot right now in terms of prevalent of thinking that people are kind of looking for opportunities and they think they're missing out. So we wanted to have an expert that come on and really kind of give us the good and the bad and the ugly in terms of real estate. So I thought Tom captured that really, really well today.
Agreed.
So I know obviously we're episode 93. So we're
getting up there.
We're approaching the century mark. Almost a golden podcast, I think is what you'd call it. So we're getting close to that. So to find a little bit more out, we're going to have some links to Union Square. We're going to have a little bit more about our show. If you go to blog.guidancepointllc.com/93 for episode 93. So you can find all that there. We really appreciate you tuning in. Again, I know real estate is something that people are really passionate about. And we wanted to make sure we were kind of true and honoring that passion here today and exploring it and all of its glory. So thank you for tuning in. We really appreciate it. We hope to catch you next time.